Hey everyone, welcome to the KE Report. Another daily editorial as I am chatting with Darrell Fletcher, Managing Director of Commodities over at Bannockburn Capital Markets. Darrell is just finishing his 2024 recap and also 2025 projections when it comes to commodities. So I got a little inside peek in what Darrell has written so far. We're going to go through that 2024 recap and get his outlook for a number of the major commodities that we cover. A lot of the energy, oil, natural gas, as well as base metals and precious metals. Maybe mix in a couple other side commodities that either did well or underperformed. Again, Darrell runs the commodities trading desk here, so very much looking at these markets from how big investors are positioning themselves and large companies are hedging their bets. So, Darrell, let's start off with a quick recap from 2024, talking about the best performing commodities. Break down the top three indexes that I see here that all were up over 20% just in 2024.
Yeah, sure. Thanks, Corey. Yeah, we looked at it was amazing at the end of the day if you look at like the broad commodity index BCom or SPGCSI, pretty flat. So then we kind of look at, okay, well, by sub-index, how did things look and how did it break out? Because we knew, natural gas did well, we knew precious metals did well. So we kind of broke those out. At the top of the chart from a index, like a subgroup perspective, softs did really well, and that's mainly driven by cocoa and coffee, just due to weather. And that kind of got into the themes of what were the themes? It was China demand was weak, which hit on the ferrous metal complex, steel, even nickel hit a 4-year low. But the increasing weather volatility, that turned out to be favorable in the softs area and in natural gas. And this inflation holding pattern, which looks like it's going to continue for a while, really helped out in the precious space. But the top three natural gas index, I think for that we just took a simple split of TTF, European natural gas front months, and Henry Hub, and that was up about 20%. So US and Europe gas. Precious metals, was all of your listeners know, did really well with gold and silver both up in that 20-30% range. I think we had 23 on our average. And then the softs, which was really pulled by cocoa and coffee. And then the whole index, like I said, really flat. Industrial metals eked out some gains. Crude index is basically flat. Energy on the whole was a little lower, but then the bottom sectors were ferrous metals to steel, like looking at HRC steel, iron ore, Turkish scrap. Like we took two or three of the larger ones and just did it an equal weighting, and you're off 30% plus. And then grains fell off too, just the grain index itself. But yeah, theme wise, and when you break these indexes down, it makes sense. China demand remained weak despite multiple stimulation efforts. Nothing's taken hold yet. The volatile weather, which we're seeing again here, I don't, that's certainly not going to change. And then the inflation holding to help out the precious metals area.
Now, that major story, China, weakness, that is something that I think a lot of the bulls are waiting for China to turn around and be that huge driver. But when you consider just how well some of the softs did, precious metals did, and even just how flat industrial metals and commodities broadly were, is that in your eyes a good sign still that China, even though they're continuing to struggle, they could be that major driving factor? Who knows, this year, next year, whenever they start to improve economically?
Yeah, I'd agree that is the case. And I know we've seen this big move in copper, pretty good move here in the past couple of weeks to start the year. And some of that's reflected in Chinese inventories drawing down to pretty low levels. Now, I think they usually have a rebuilding of inventory coming up here before the China New Year. But yeah, I mean, and especially if you're kind of a mean reversionist, looking at industrial metals holding pretty flat, even with low Chinese demand, you would think is kind of, but yeah, it's going to continue to be a big driver. And then on top of that, just globally, all the unknowns in place right now, with the U.S. administration turnover, tariffs and trade talks, sanctions of the day. I think that's going to continue to create some noise first quarter, but if we can get through that, you think through, confidence is going to be a big deal. And that's why I'm kind of generally constructive as we get through into the second half of the year on the base metal complex and a couple others.
Let's talk about 2025 then, because look, in all fairness, that's the most important because that's what is ahead of us. So far, though, just a quick recap of where we stand about halfway through the month of January. We're off to a pretty strong start for a lot of the commodities. Precious metals are broadly flat, I guess, but look at the energy markets. Crude is up to $78. Copper is also rebounded, and natural gas recently hit $4. What do you take away from this strong start to the year?
Yeah, it has been a pretty impressive start to say the least. Crude oil now I think is up about 9-10% year to date. The Fed contract, WTI. Three things on the crude, and it's pulled into energy, and weather's part of it also. One is the sanctions that were announced late last week and just the continued trade tariff talk. U.S. inventories have been falling, and it's been cold. I mean, and we're going to have a really cold shot of weather coming through the U.S. The entire country just about is going to be below norm through the end of January. So it's interesting because November and December were so well above normal, and now we're hitting this really prolonged cold snap. You see it in the distillates, diesel fuel, heating oil is up 10% year to date. Natural gas is up 13% year to date. So the whole energy complex has been really strong. It's spilled over into metals to some extent, even despite a kind of a stronger US dollar to start. So there's been a good bid across the entire commodity complex to start the year here.
This is also in the face of a higher US dollar. Usually, or I guess I shouldn't say usually, but there are times when a higher dollar means lower prices for commodities because how everything is priced in dollars. But hey, this correlation is not always the case. And recently, we've seen the dollar rising quite strongly with this pop in commodities. Even precious metals have been moving higher with the dollar moving higher. What do you take away from this relationship, at least currently, Darrell?
Yeah, that's interesting, Corey. I think, some of the interest rate reductions that were maybe forecasted in the market have been softened for sure, and some of the jobs data we saw last week here were strong. So it looks a little sticky inflation. We get CPI and PPI both this week, and those are going to be big numbers for kind of what the Fed does going forward here. But in terms of that correlation, yeah, in a vacuum, that would be the case. I think if you look at something like energy in the face of a stronger dollar here to start the year, the fundamentals are really taking over. So yeah, everything equal, you would have that correlation, but I think the fundamentals here in energy are pretty strong right now, given the combination of the things I mentioned. And that's kind of what we're seeing. And if you look at it, it's truly more impactful in the energy space. The sub index is up about 9% year to date, and then the LME base metal index also up, but only 2.5. So typically, the dollar is going to affect that correlation will affect more in the metal space and certainly the precious metal space.
What are some of your strongest convictions then for 2025 in terms of upward potential in any of the commodity sectors?
Yeah, great question. I've struggled and I've talked to a lot of my friends in New York and different areas about how do you feel? And getting a high level of conviction across the board, I think, has been tough for everyone. We have a new administration. China economy is still weak, maybe showing some signs, and then the tariff threats and sanction announcements that come kind of daily is making it really difficult. So trying to look beyond that, I'm generally constructive on natural gas. I think at my note I said constructive, but with a split tenor, meaning I think the front might be a little overdone. If you look back at a similar storage condition, at least in the US, it looks like we're going to trend towards what we looked like in March of 23, and natural gas was about $1 lower at that point. We get to about 1.8 TCF, it looks like. But I do like it, longer term constructive for LNG. And the forward curve has become amazingly flat. I think we're like 370 to 390 all the way through 28. So I could see these floors like 350-ish being a really going forward where people are like, well, that we're going to buy there. I could see that being a floor. So I think that's kind of constructive. I'm constructive on precious metals for the same reasons as 24. There's a lot of unknowns, a lot of central bank buying. It seems to be the safe haven that's going to stay in place. And, let's assume potentially that the dollar does revert back a little bit, and it's going to be a little more constructive. I'm mildly constructive on base metals. Like I said, it's a mixed bag again, similar to 24. But you know, and same thing on ferrous. Just it's a bit of a bet on China finally turning the corner, and if nothing else, it's a mean reversion for steel, just because it's so low and the forward curves are steep. Except for iron, where it's pretty flat.
What could change some of these outlooks then, Daryl, in terms of big picture themes, big picture news events? What could change some of these outlooks either for the better or for the worse?
I think for the better, it's going to take time with this administration turnover and how they're going to handle trade. That's going to be at least through the first quarter. Having that noise, getting some direction and clarity around those policies will be very helpful globally to get some confidence back in the market and get some capital spending. I think that's the biggest thing right now, and it's going to take some time.
Okay, let's talk about precious metals then. That's one of the first ones you led off with, saying that you still see this outlook for precious metals continuing. Does that mean we could see another 20+% year for gold, silver, the precious metals broadly because of, I guess, these tariffs and, as you even note, this further central bank buying?
Yeah, I would not be surprised at all. I don't know if it'll be 20%, but if we get some retests of the highs, I think silver is 34 would have been the test on that, and gold um, trying to push back up over 2,700 to 2,800. I could definitely see that play out.
How do the equity markets factor into this then? We have a lot of guests that say the equity markets need to drop for even more money to come into precious metals. Do you subscribe to that theory?
Yeah, I do. I mean, I think if equities, if you look at it, especially U.S. equities being overvalued to some extent, however you want to measure, that's not my asset class, but that would definitely help out precious metals also. So I think there's a lot of things in place that could keep that trend in place on precious.
What are you seeing in terms of Western demand for precious metals then? Because it seems like over the last couple of years, we've been talking so much about big demand coming out of the East and the Western investors still largely ignoring or not paying as much attention to precious metals. Do you see the same thing?
Yeah, to some extent. I mean, I try to follow fundamentals a little closer too, and I like the use cases in silver and things, in that area. I think if you saw my chart, it was interesting that silver and tin led the base market last year, and silver and tin were like right next to each other in the 20 or 30 commodities we followed in terms of looking at the year over year. So it was interesting. Again, it'll come down to just confidence in this administration turnover and where the Fed goes to. But I do think it's got a lot of good things in place for it on the precious side.
Now, oil, nat gas. Look, nat gas is just doing so well right now, but it is also a market that is largely volatile, and we are going through cold snaps almost across the country and even up into Canada. How much higher could nat gas go here? Are we in for a potential another spike move like we saw in 2022?
Good question. I know some of the cash markets around here were hitting 5 on Friday. Front month Febs, I think we're, trying to push 4, but it's having a hard time doing that. The curve is really flattened out. Storage, like I said, year over year, we flattened out to there's really no overage versus last year. And it looks like we're going to trend towards like 1.8 TCF, which was into storage here in the US, which was where we were back in 23. We already know the pool last week was really low. It was like 40 BCF, but I think the next three storage pools here in the US are minus 250. They're big. So that's how we're going to get down here to about 1.8 TCF. You would have to have the weather really the same type of weather roll into February almost. So certainly we could have some pushes towards 5. I don't think we're going to have huge spikes. Forward curves are flattened out, 370 to 390, pretty impressive all the way through 28. So when you have that flat of a forward curve, I like that, and that's the value when it goes out that far. Yeah, so we'll have some big pulls here in the next few weeks, and probably you're going to be ranged here between 4 and 5 until we get through the end of January. And like I said, if you look back at 23, we were a good 50 cents to a dollar lower in the same inventory environment coming out of March, April 23.
What about oil then, too? Oil's gone through a pretty big spike in price. It is still largely range bound, and I see from your note that it looks like you're also thinking that it's mostly range bound, but also potentially lower. What are the drivers between oil throughout the rest of this year?
Yeah, we've had a nice move up on the front here for sure. My range to lower status is already at risk, but I don't think we're going to have any big blowouts in oil. I think a lot of this move right now tends to shifting of barrels and creating global basis differentials more than anything. The barrels are going to go somewhere. If you look at the fundamentals, I think we're still in an oversupply situation in 1Q and 2Q. And so I really like to follow the forward curve here, which is lower. All of this move has been up in the front for the most part. Your spreads from the first month to the second month are really sharp. They're like $1.50 a barrel. But if you look out, say let's go out to Cal 26, you're only up about $1.50, and that's sitting at like 67.50. So I'm not super constructive on the crude here, and this range has been 70 to 90 for so long. If anything, I would see later on in the year maybe a test of that 70, and then I think 68.50 would be the next level down. So I'm kind of range to lower still on that. And what will the new administration do? I mean, they've pledged for lower energy prices, and it's a global market. It's not just us, so it'll be really interesting.
Yeah, so much still is around these tariffs, right? That's the big question mark here, and we just don't know what's going to play out. But that can definitely have an impact on a lot of these commodity sectors. One other more smaller commodity, I guess, that I want to touch on that you quickly note in this report is nickel. Look, has been suffering. Nickel has not done very well, but is there potential that nickel kind of gets off the mat this year?
Yeah, that hit a 4-year low late last year or late in the year. Yeah, right towards the December. So that, if you look at nickel, it's very much looking like the ferrous sector. So you get the stainless steel, general infrastructure, China demand. That's kind of been a similar, tell there. So yeah, I would kind of put it in that same group that if you're going to be optimistic, you're looking for a second half type turnaround, some confidence globally to help capital, and if China can, turn around also. So I could look for some mean reversion on that also.
Okay. So, Darrell, I guess that pretty much sums it up here. We're all still waiting for what these tariffs are going to be. And yes, we're all going to have our eyes on inflation data and anything that moves the needle for the Fed. But look, the Fed is winding back at least some of the expectations for rate cuts throughout this year, now even into the second half of the year. What's your big takeaway from this year then, in terms of your theme and maybe how it differs from past years?
I think this year, yeah, the interest rate picture will be telling. I think the numbers we get here in the next month or two on CPI, PPI will really set the direction. I'm kind of optimistic just from a global confidence perspective. Once the administration turns, we can get through some of this noise, tariffs and sanctions, some clarity there. Hopefully China can start to get some momentum also. So I'm generally, constructive in the metal space, precious space, oil, oil in the products group to be, range bound again. And it'll be interesting. We'll have a lot of volatility. We're off to huge volatility already to start the year. So it's a good space. I like it.
Hey, maybe that will be the theme. Volatility throughout the year, but again, so much is going to be almost tweet based and policy based that undoubtedly creates volatility. Again, Darrell Fletcher, Managing Director of Commodities over at Bannockburn Capital Markets. Darrell, it's always great having you on the show. Thanks for the update today.
Great. Thanks, Corey.